Hi, welcome to the Lance Roberts Show podcast. And of course, one thing that we've talked about a lot lately, of course, that worries investors is bear markets. And of course, what happens during a bear market. And it's interesting because a lot of it depends on your perspective. If we look back in time in 2000, most people didn't worry about a bear market too much. It was just, we were young, investing, we had plenty of time to retirement, so really didn't worry about a bear market. And this is one of the issues that comes up with markets. They say this time isn't different or this time is different, whatever it is. But one thing that is different between one cycle and the next is that you're different. Your time frames are different, your goals are different. And the one thing that we're going to talk about today is, should retirees actually worry about a bear market? Now, the answer would seem to be obvious, right? But it was interesting because Mark Hulbert, who writes for MarketWatch, wrote that the reason not to give up hope is that the stock market typically recovers from bear markets in a shorter period of time than most people think. Believe it or not, the average recovery time is just 3.2 years. So you shouldn't worry about a bear market, right? I mean, the market goes down, you basically get all your money back in 3 years. So what's there to worry about? Well, the problem with the article is, and the one thing you should consider, again, is where you are in your life cycle. If you're young, you're 30 years old, and you've got 30 years to retirement, well, maybe you don't worry about a bear market. Maybe you just dollar cost average in, wait for the markets to recover, and go on. Well, we won't get into the issue of the lost time in there. The important thing, though, is that when you take a look at what Mark Hubert's talking about, is that you have to think about it from the perspective of somebody who's actually in retirement. There is a difference. During our younger years, we're accumulating, but during our retirement years, well, now we're beginning to distribute. We're beginning to withdraw from our investment accounts. And so the one thing to consider is the impact of the withdrawal rate in retirement. Michael Keitzes, a famous certified financial planner and has done a tremendous amount of research on financial planning and retirement. He laid out a very interesting premise talking about a retiree with a $1 million portfolio in a balanced portfolio, so stocks and bonds. He made some assumptions on this, saying that inflation averages 3% a year and that a balanced portfolio averages 8% every year over the long term. So over 30 years, you would generate 8% a year from a balanced 60-40 portfolio in an environment where inflation was averaging 3%. Now, the one interesting thing here is that while he says the balanced portfolio averages 8%, now remember the long-term return on invested S&P 500 is 6% with a 4% dividend yield. Today, that dividend yield is 2%. And you're still yielding around 6% on an annual rate of return. So 8% there versus a balanced portfolio of 8%. We can talk about the issues of expectations, and we'll talk about that in a second. But the point here is to make money last for the entire time horizon, the investor would have to draw out money starting at $61,000 a year and then increasing that by the inflation rate every year. So this includes the fact that the cost of living rises over time. And his analysis came out pretty simple, that over a 30-year period, the retiree would not run out of money in the environment where even the spending was continuing to increase over time to adjust for inflation. But again, this analysis, while correct, also doesn't really assume the impact of withdrawal rates. And of course, since most people's money is in retirement accounts like 401ks and SEP IRAs, etc., the impact of taxes paid out on those withdrawals. So if we take this and we modify the idea and start to include some of these other issues, here is Michael Keitzes' projection, same exact structure, $1 million account, balanced out, runs out for 30 years. Once we include the impact of taxes, we get a little bit different story. So this is the inflation-adjusted return. So now we're taking out the cost of inflation, and now we take out taxes on top of that. All of a sudden, the life expectancy of the portfolio is substantially shorter once you start including the impact of these other issues. But there's another issue on top of this that we haven't really talked about. All this assumes a stagnant rate of return, that every year the portfolio generates X rate of return. But we know from history that markets don't return the same amount of money every single year. Markets don't average anything. what they do is they have variable rates of return. Every year is different. And of course, that also impacts the portfolio during a distribution phase. So if we take a look at the impact of the growth of money over time. Now, this is the S&P 500. And what we know is that over a 30-year period, from any point on the valuation scale, the returns basically are different. And the higher the valuation today, the lower the return is going to be over the next 30 years. So given that right now valuations are above 20 times earnings on the S&P 500, we went back in history and looked at every period where the starting valuation in the markets was above 20 times earnings. That was 1895, 1922, 1962, 1992. Those returns going forward over the next 30 years all fell basically below the average rate of expected returns over time, which is an 8% annualized rate of return. So the point here is that because markets have variable rates of return, the impact on money from higher valuations is lower over time. So if we take the average of this and look at the average return of the market, we find that the average return of the market over time is actually substantially less than an 8% annualized rate of return. Again, not surprising because of variability. Now, how does that impact the portfolio? See, this is the important thing, because every year markets don't rise. So back to Mark Hulbert's original question, should retirees worry about a bear market? The answer is absolutely yes, because distributions during a bear market become much more important. Because if the market's down 10% in a given year and your withdrawal rate is 4%, the portfolio will be down actually more than 14% because of the impact of the withdrawals during the decline phase of the markets. So what we have here is the same $1 million portfolio, but this time it's measured against the average rate of return of all those periods throughout history where starting valuations were above 20 times earnings. What we find out here is that the same $1 million portfolio, but this time based upon the variable rates of return of all the periods throughout history where valuations had started at a high valuation above 20 times earnings, we find that the portfolio life expectancy is no longer 30 years, but on a return basis, it's now 28 years. But again, we have to include now the impact of inflation and taxes on the portfolio over time, including the spending and the withdrawal rates. All of a sudden, when we include the spending and inflation adjustment, we drop the life expectancy of the portfolio from 30 years to 28 years to 22 years. And once we include taxes, that falls to just 18 years before the retiree actually runs out of money. So the important thing to take away here is that importance of bear markets is extremely critical to investors, particularly in just before and into their retirement years. So here's some guidelines to think about, some questions to ask your financial planner about your plan. The first one is what are your expectations about future returns? If the answer is 8% a year, you should seriously re-question that because, again, with valuations currently well above 20 times earnings, in fact, some of the most elevated levels in history, the dynamics of lower future returns is going to have a very important role into your financial plan. The second is, should withdrawal rates be downwardly adjusted? Again, with the expectation of higher volatility and high valuations leading to lower returns, instead of expecting a 4% withdrawal rate, should that be revised down to 3% or 2% to ensure the survivability of your plan over time? The other question is, of course, the fact that we've already been in a decade-long bull market. Every market cycles, so have adjustments been made for periods of time where there are potentially negative rates of return and potentially substantially so? Again, a bear market. The other is that the impact of taxation, has that been included and carefully considered in the plan? And also the future inflation rates. Do you expect future inflation to be higher or lower than today? And how will that affect the cost of your living and potentially your spending requirements needed from your financial plan? Drawdowns from portfolios, has that been considered during that declining market environment which accelerates that principal bleed? Has harvesting of gains been done to harbor capital during up years so that withdrawal rates on portfolios during down years can be mitigated or eliminated entirely? Of course, as the yield chase has occurred over the last several years, investors have been chasing yield because of low interest rates. That's led to a lot of valuations where there's an extremely risky environment in assets which are highly overvalued that are typically considered to be safe investments, but no longer may be the case. And then, of course, what steps should be considered to reduce potential credit risk? In your bond portfolio, we're in an environment where, again, we have 50% of the entire corporate bond complex rated BBB or less. So the credit risk and duration risk in a bond portfolio in a balanced plan can certainly have an important impact on your future survivability. And then lastly, of course, have expectations for those compounded annual rates of return, that 8% a year, which doesn't really happen. Have adjustments been made to account for variable rates of return, which is a much more realistic forecast for your financial plan? If you have any questions or comments about this or need to adjust your financial plan, be sure and contact us at realinvestmentadvice.com. We're always happy to help you. We'll be happy to review your plan and make some recommendations based upon these principles, which is what we employ here at RIA Advisors. Also, make sure and follow us and get our podcast at Lance Roberts Show on YouTube. And of course, at RIA Advisors, we always appreciate your time. Thank you. I'm your host, Lance Roberts. We'll see you next time on the next edition of the Lance Roberts Show podcast.